The Dow finished up about 0.5%. The S&P slipped 0.2. The Nasdaq fell 0.8, and gold had its best day in months. On a tape like that, the index level tells you almost nothing.
It doesn't. And the honest version of today is that the interesting part happened after the closing bell, not during it. 5 companies that matter to the AI build-out reported tonight, and together they say something quite specific about how this market is pricing news.
Give us the closes first.
Dow 54,349.12 hill, up 0.49%. S&P 500 at 7,723.55, down 0.17. Nasdaq Composite 26,363.44, down 0.83. The semiconductor index fell 1.4% to 12,008.88. And gold futures settled at $4,305.20, up 3.67%, with the gold miners up 7.39%.
So the defensive end of the market had a very good day, while the growth end had a mildly bad one. And then after hours, 3 companies beat expectations and got sold anyway.
That's the episode. The bar has moved, and tonight, it's measurable. Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research.
Start with gold, because the explanation you'll see everywhere is wrong.
2 soft labor prints landed the same morning. Jolt's job openings came in at 7.36 million against 7.44 expected, down from 7.54 million. And ADP private payrolls added just 44,000, the weakest reading since February.
And the usual story is weak jobs, rate cuts coming, gold rallies.
Except that is not what this market is pricing. The market is not pricing a cut. It has been pricing the odds of a September rate hike, and those odds fell from about 67% to about 55%.
So it's not that help arrived. It's that a threat receded.
That's the distinction, and it matters, because those two things behave very differently afterwards. And look at the confirmation. The 10-year barely moved at 4.63%, and the dollar index only slipped to 99.69. No panic in either, just less tightening risk.
And one number to keep us honest.
Even after a 3.67% day, gold futures are still roughly 24% below the record they set in January. A powerful rally inside a much larger drawdown. Best day in months and near the highs are very different sentences.
Now the pattern. And I want to build it one row at a time because the shape only appears at the end.
AMD last night, revenue up 50%. Data center revenue up 107%. Guidance raised. The stock closed down 7.04% today.
AppLovin tonight. Revenue up 53%. Fell somewhere between 16 and 24% after hours. And it was still moving when we recorded.
Western Digital tonight, revenue beat, earnings beat, a record 54.4% gross margin, and guidance above expectations. It fell 5.36% during the regular session, and then about another 11.8% after hours.
So a doubling data center business, a 53% grower, and a company printing record margins. All 3 beat. All 3 got sold.
And before anyone says that's just 3 anecdotes, it isn't. There's a market-wide number underneath it, and that's the next scene.
This is the statistic the whole episode rests on, from FactSet.
This quarter, S&P 500 companies that have beaten earnings estimates have moved, on average, plus 0.1%. The 5-year average reaction to a beat is plus 1%.
So beating is currently worth about 1/10 of what it has historically been worth.
On average. And that reframes every one of tonight's reactions. None of these companies were punished for being bad. They were priced for good in advance, and then they delivered good.
Which gives us the sentence for the whole night. The bar is no longer beat. The bar is surprise.
And notice that this is falsifiable. It's a number you can look up. It will change over time. And if it goes back toward 1%, the regime we're describing has ended. That's the kind of claim worth making, because you can check it.
AppLovin is the sharpest illustration. So let's do the detail.
Revenue was $1.92 billion, up 53% year over year. The estimate was about $1.94 billion. So they missed by roughly 1%. Adjusted earnings were $3.76 against $3.75 expected. That's a beat. Third quarter guidance came in with a midpoint slightly below consensus.
And management gave a reason.
They said their growth models underperformed. which is a notable thing for an advertising technology company to say because the models are the product.
And the reaction?
The stock closed at $417.80 and then traded down into the low to mid 300s after hours.
So a company growing revenue at 53% missed by about 1% and lost something like a fifth of its value in an hour.
And here's the part that matters for tomorrow. The reaction did not stay inside AppLovin.
Because software names move together after hours, and AppLovin is the only one of them that reported anything.
The cleanest example is Salesforce. Salesforce did not report tonight. Its earnings are weeks away. In fact, it had a good day, up 1.04% in the regular session on a new $1.6 billion contract with the Department of Veterans Affairs. No bad news, no guidance change, nothing company-specific at all. And it traded down about 5% after hours.
On nothing.
On somebody else's 1% revenue miss. Now, two honest caveats. After-hours moves in non-reporting names happen in thin volume, and they frequently reverse by the open. So this may look different in the morning. And we cannot see order flow, so we can't prove the mechanism.
But the plain description is available.
The plain description is that a sector got repriced by association. One ad tech company's models underperformed, and the market marked down enterprise software that has nothing to do with mobile advertising. Whether that's index mechanics, hedging, or just reflex, the effect is the same. And it's the most useful signal of the night about how this market is behaving.
Which raises the obvious question. If AppLovin drags software down, what does that actually tell you about software?
Almost nothing. And this is the part I think is genuinely worth your time tonight. The software ETF closed down 0.68%, and it sits about 14% below its own 52-week high. That sounds like a sector and a modest drawdown.
And it isn't.
It's an average of two completely different groups. On one side, Snowflake is 1.9% from its 52-week high. Datadog, 3.3%. Those are effectively at the highs.
And the other side?
Oracle is 58% below its high. HubSpot, 52. AppLovin itself, 44. Atlassian, 40. ServiceNow, almost 40. Workday, 32. Adobe, 30. Salesforce, 28.
That is not a sector. That's two sectors wearing the same ticker.
And the split is not random. The names near the highs are the ones priced on consumption. You pay for what you use, so when AI workloads grow, their revenue grows automatically. The names 30 to 58% down are largely per seat or legacy license models, where more AI usage does not mechanically mean more revenue, and might even mean fewer seats.
So when AppLovin falls and Salesforce falls with it, the market is treating them as one thing.
And the data says they haven't behaved as one thing for a year.
So let's put the question properly, because we don't know the answer, and I'd rather say so.
The question is whether that gap keeps widening, closes, or flips. And there are three specific things to watch this week and next, all of them checkable.
Go.
First, do the consumption-priced names keep their premium when they report? It's easy to hold a high multiple until you have to justify it. Second, does anything in that 30 to 58% bucket get bought on a beat? Tonight, the answer was no, 3 times. If that changes, the regime we described in Scene 4 is loosening.
And third?
Whether tonight's sympathy move reverses tomorrow morning. If Salesforce opens roughly where it closed today, then what we saw after hours was thin volume noise. If it opens down, then the repricing was real and the market is genuinely re-rating per seat software, often ad tech print.
That's a clean test, and we'll know within a day.
And we set this same test up a week ago. Consumption versus per seat. It keeps producing evidence, and it keeps pointing the same way, which is worth watching precisely because it hasn't broken yet.
Because one company tonight was rewarded enormously, and it's instructive.
C-Time. Revenue of $157.4 million, up 127% year over year, against about $146.5 million expected. Earnings of $2.34 against $1.95. Their communications and data center segment did $101.2 million, up 181%, above $100 million for the first time. And they guided the next quarter to $285 to $295 million, against a consensus near $164 million.
That headline reads as roughly 75% above consensus.
It does, and that is where you have to slow down. C-Time closed the acquisition of Renesas' timing products business on the 1st of July. That business alone is expected to contribute about $85 million in the third quarter.
So a large part of the guide is an acquisition. not a demand surprise.
Take the $85 million out, and you get roughly $205 million organic against a $164 million consensus. Call it 25% above, which is still an excellent quarter. It is just not a 75% shock, and the difference matters if you're using this as evidence about end demand.
And the stock?
Fell 6.85% in the regular session, then rose around 34% after hours.
So even the night's biggest winner needed the filing read rather than the headline.
And what's underneath it is genuinely on thesis. Management said AI customers are placing orders 12 to 18 months in advance, giving them visibility into 2027. And the growth is coming from the 800 gig and 1.6 terabit optical module ramp. Timing chips, one of the least glamorous components in the rack.
The money is still flowing. It's just not paying for good, only for genuinely surprising. And the surprise came from a component most people have never heard of. And more, because it separates two things that get confused constantly.
Fluence Energy fell about 27%. Revenue was $649.8 million against $811 million expected, a 20% miss, and they cut full-year guidance by roughly $500 million.
That sounds like demand collapsed.
It's the opposite. Their backlog hit a record $6.4 billion, and order intake was $1.44 billion, close to 3 times last year, driven partly by data centers.
So orders tripled and revenue missed by 20%.
Because they couldn't build fast enough. That's an execution miss, not a demand miss. And the two mean opposite things about the industry. A demand miss says the build-out is slowing. An execution miss says the build-out is outrunning the supply chain's ability to deliver.
Which is the same message SitTime just sent from the other direction.
Orders booked 12 to 18 months out. Both companies are describing demand they cannot serve on time.
Now, the largest number of the week, and it needs the accounting stated correctly, because several outlets got it wrong.
Reuters reported Tuesday that Alphabet, Microsoft, Meta, Amazon, and Oracle have together signed roughly $1.09 trillion in future data center lease commitments.
And the word hidden got attached to that in a lot of coverage.
It shouldn't be. These leases haven't commenced yet, so they aren't on the balance sheet yet. That is ordinary lease accounting, not a scandal. But, and this is the real point, they are contracted and they are fixed. If demand disappoints, the payments do not.
And Alphabet had its own day.
Down 4.03%, after 4 of its most senior AI researchers left together to found a startup called Discovery Loop, including chief scientist Jeff Dean and Gemini's technical lead Oriol Vinyals.
Which is a genuinely significant departure by any measure.
It is. And I'd separate the two stories because the market blended them. The departures are a talent story. The 4% is at least partly a spending story. Alphabet is spending itself toward negative free cash flow to build this infrastructure, and the market has been marking that down for weeks.
So here's the second question we can't answer, and I want to frame it fairly.
Every dollar of that capital expenditure is somebody else's revenue. SitTime proved it tonight from the timing chip layer. Fluence proved it from the energy storage layer. The spending is real, and it is landing in other companies' order books.
But the companies doing the spending are being marked down for it.
Which is a coherent thing for a market to do if it doubts the return. So the open question is, what evidence would make $1 trillion of contracted commitments look cheap rather than reckless? And I don't think anyone knows yet.
What would you watch?
3 things. Whether the capital expenditure guidance from the big spenders keeps rising at the next round of reports or starts to flatten. Whether the revenue those build-outs are supposed to produce starts showing up as a separately disclosed line rather than a promise. And whether the suppliers, the SitTimes and the Fluences, keep reporting order books that stretch into 2027 because that's the build-out being financed rather than announced.
And if the order books shorten?
Then the spending was ahead of the demand, and we'll have found that out from the supply chain before we find it out from the hyperscalers.
Quick change of gear because a viewer pushed back on last night's episode, and the pushback was good enough to check.
The comment was, inference at scale is fabric-bound, not GPU-bound. And if indium phosphide supply stays restricted, the optical layer has a hard ceiling.
And the first half doesn't survive.
Mostly not. When a model writes text, the limit is memory bandwidth. Every word requires streaming the whole model out of memory, and the compute cores sit largely idle while that happens. The network only becomes the constraint when a model is split across racks.
And there's a fact that settles it.
Inside NVIDIA's flagship rack, the 72 GPUs talk to each other over roughly 5,184 copper cables. Not fiber. There are 0 optical transceivers carrying GPU to GPU traffic. The most advanced AI system in production moved that traffic to copper because at rack distances, copper is cheaper, cooler, and faster.
And a caveat, because this doesn't stay true.
It flips around 2027. At the next generation of link speeds, copper physically cannot reach much past a meter, and optics becomes mandatory. So optics is a real story. It's a 2027 story. And notice C-Time tonight said customers are ordering 12 to 18 months out with visibility into 2027. That is the same clock being described from inside the supply chain.
Which brings us to the correction, and I want to do this properly because we got something wrong.
Last night, we pointed at indium phosphide as the next bottleneck. The shortage is real. Wafer prices went from about $1,400 to around $5,000, and supply is roughly 70% short of demand. But we implied something closer to a rare earth situation, and it isn't one.
What's the difference?
4 questions. Is the raw material scarce? No. The whole indium phosphide industry uses maybe 50 to 100 tons of indium a year out of about 1,080 tons produced globally. Flat panel displays use most of it. Is the constraint geology or a factory? A factory, indium is a byproduct of zinc refining that's already being produced, and the bottleneck is crystal growth furnaces. How long does new capacity take? 2 to 3 years, at maybe $10 to $20 million a line. A new rare earth mine takes 7 to 15.
And has the capital committed?
Heavily. JX has put something like $780 million into expanding capacity several-fold. Sumitomo is going for roughly 3 times, against a substrate market worth about $390 million a year. The cure is already funded.
And the second thing we got wrong.
We described AXT as being on the wrong side of its own story because it grows its crystals in China and needs an export license per shipment. Then we checked whether it had reported. It had, on July 30th, revenue $47.6 million, up 164%. Indium phosphide revenue a record $30.7 million. Non-GAAP gross margin of 45%, up from 8.2% a year earlier. Backlog above $100 million and nearly $48 million of customer prepayments.
So the licenses are flowing, and we misattributed an earnings move to a policy headline.
Because we looked at the price instead of reading the results. The same mistake we nearly made with II Time tonight, in the opposite direction. And the useful part isn't that the stock went up. It's that a gross margin going from 8% to 45% in 12 months is what a cycle looks like when it turns, and that the company benefiting most from this shortage is the one spending hardest to end it, funded by prepayments from the customers who need it to end.
So what do we carry into tomorrow?
Not every shortage is a moat. A moat is something competitors cannot cross. A shortage is something they can. It just takes 2 years in a purchase order. Ask whether the constraint is geology or a factory. If it's a factory, you're looking at a cycle, and cycles end.
And 2 questions we're leaving open. Whether the software split holds, and what would make $1 trillion of contracted spending look cheap. We'll know something about the first one by tomorrow's open. That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.